Welcome to the Capital News. I am your host, Alex Karitis. Today is March 8th, 2019. Thank you so much for joining me. I know I was off yesterday and there was some exciting news in the markets. There was obviously a down day, nothing too severe. It could just be a natural pullback. Again, we've been discussing this for quite some time now, that the markets were hitting some technical levels that they had a lot of difficulty breaking through in the past, and it didn't seem like there was enough momentum. There really wasn't any sort of positive catalyst around the world or in the United States to have these markets break through that threshold. So let's get into some of the news that went through yesterday and continued through today. So the S&P continued its decline by 6 points. The Dow closed down 23 points. The Nasdaq was down 13, and the Russell 2000, the small cap index, was down 1 3/4 points today. Of course, all of these indexes were well off their lows. I mean, well off their lows. They were able to stage a very strong comeback in the last couple hours of the trading session. Now, we had oil, which closed above 56, but was actually below 55 at one point during the day. I'm going to touch on that in a little bit. And then gold and silver also had a nice recovery, increasing 1% and 2% respectively. And then we saw a continued flight to safety, presumably still thinking that Uncle Sam can pay his bills, and the 10-year Treasury the yield is now at 2.63%. So obviously, if you bid up the price of a bond, the yield goes down. So there was a flight to safety, bidding up those bonds, and the yield now sits at 2.63. The dollar was stronger on Thursday, but gave back some of that today. The increase in the dollar strength, I think, was primarily driven by the announcement by Chairman or President Mario Draghi of the ECB that they too are becoming dovish on the Eurozone and the global economy. And while they were talking late last year of also starting to reverse course and become less dovish, more hawkish, let's rein things in, let's pull back our quantitative easing program, let's start getting on a track to increasing interest rates, well, boom, bang, bust. They flipped, just like the Federal Reserve has and just like so many other central banks the world over. Do you really think this is a coincidence? Do you think these people don't know what they're doing? I mean, these guys all get together. I mean, they all have the same job title. They all get together in, Jackson Hole, Wyoming, once a year for their big conferences. I mean, there's emails, there's fax, there's the telephone. I mean, these people communicate with each other. Do you think it's a coincidence that the major central banks the world over have all done 180s? I don't. I don't think it's a coincidence. You shouldn't be surprised when they do this. So, of course, that led to weaker strength in the euro. So the euro got weaker. And, of course, the dollar rallied on that news. And the euro got hit pretty nicely. Again, I told you guys repeatedly, if the Eurozone ceases to exist, the European Union ceases to exist, and or the euro ceases to exist in its current form and in those current states within 5 years, I'm not going to be surprised, and neither should any of you, because this is just chaos run amok. That's all it is. They have the horse is out of the barn, and he ain't coming back. That's what this is. And I'm going to start tying all of this stuff together because there's just so much information on a daily basis, it's not even funny. And you have to connect the dots, and you have to pay attention to who's talking. Do your best to read in between the lines and protect yourself and act accordingly. You just have to do it because these markets are so headline driven, it's sickening. It's really disgusting. Whether it's a tweet from the President of the United States, whether it's a statement or a speech by Chairman Powell of the Federal Reserve, or President Mario Draghi of the ECB, or somebody from the People's Bank of China, or whether it was the governor of the Bank of Canada. We had that discussion where they did a policy 180 as well, and they're softening. Or it's the governors out of the Reserve Bank of Australia, and they're doing a 180, and they're getting dovish. Or it's the Bank of Japan. I mean, this is just a who's who of central bankers saying we're ready to put the pedal to the metal and do what we got to do. Or at least we're going to be in wait-and-see mode. At the very least, wait and see. At the very, very least. So this all gets back to, I told you I was going to get back to some of the news in the oil markets. Again, from just a high level of looking at the price of oil. You're looking at supply and demand functions, you're looking at geopolitical risk, and you're looking at the strength of the dollar. The strength of the dollar because commodities are priced in U.S. dollars. Okay? Now, we had President Trump give his speech at CPAC. We've covered this numerous times, that he is calling for a weaker dollar. He's calling for a weaker dollar. That's not good for many Americans, especially those who live on a fixed income, and especially for those 78% of Americans who supposedly live paycheck to paycheck. That's not a good situation. That's not a strong, vibrant economy. That is not an economic miracle, in my opinion. You can feel free to disagree, and by all means do so, but I am not going to join you in feeling and thinking that way, because this is a mirage. It's a charade. It's a big Ponzi scheme, and it will not end well. But instead, we have to be concerned with stock markets making new highs. Again, why this president is obsessed with the stock market is beyond me. Is it the ego? Is it the vanity? He's got to stop this stuff. He's got to knock it out, and he's got to get upfront and honest with the American people and tell them what's going on. He just has to. He just has to say these paths that we are on and have been on for such a long time are unsustainable. You've been lied to. You don't like these politicians. Congress has terrible ratings. Yeah, you might like your guy, your congressman. Yeah, you might like one of the two senators you have in your state. But as the whole, you don't like them. You don't trust them. So are you surprised that they've lied to you? Are you surprised that we have $22 trillion in debt and rising every second? Are you surprised that we have $100 trillion in unfunded liabilities? I mean, come on. Let's wake up here. Get your act together, people. Come on. Let's go. So if you're calling for a weaker dollar, what do you think that's going to do to the price of oil? What do you think? It's going to make it more expensive because it's going to take more dollars to buy oil. Well, didn't the president love low oil prices? I mean, he's arguing against himself. I don't know if he realizes it. Then I also told you my guys' prediction with oil. I think that the global slowdown that is occurring, those demand effects are going to outweigh the production cuts by OPEC in Russia. Okay, that's what I believe. So is it possible that we get another short-term, another upswing, another little rally in the price of WTI and Brent crude oil prices? Sure, it's always a possibility. We're living in a financial world of Oz. Anything is possible now because you don't know what headline's going to come out, whether it's true or not. Actually, the bigger the lie, the bigger the rally you're going to get. So, sure, it could go up. But net, I think it's going down. That's the direction of it because we are in the midst of a global slowdown. No ifs, ands, or buts about it. And if we have a dollar that continues to rally because, again, the dollar is the best-looking girl at the dance relative to the Australian dollar, relative to the Canadian dollar, relative to the euro, relative to the British pound. And again, you have all of that noise going on with Brexit. What's going to happen there? That's such a binary situation. If you are trading currencies, you better be careful. You better be careful because that is so binary. And I'm sure if you are, you're probably sophisticated enough to know how to protect yourself, put in your stops. Maybe you're doing it through options or whatever. But that is such a binary situation. That vote is supposed to take place next week again. And if it doesn't happen, then they get to vote to see if they want to extend Article 50, which means the March 29th deadline gets extended even further. To what date? Only God knows. But I bet that's probably what happens. I hope they vote for the deal and leave and be done with it. Again, they are going on 3 years. 3 years that they knew that this is what the will of the people was. It's the 11th hour. It's the 11th hour and 50th minute, and they still don't have this thing together. I mean, you got to be kidding me. What are we doing? Are we adults? Are these just, is this just make-believe? What are these people doing? What are we doing? And I'm talking about it. I mean, who's crazier, them or me? I mean, I don't understand it. It never ceases to amaze me. So that's the thing with the oil. You got a president who wants a weaker dollar, but he also wants weaker oil. I mean, go ahead. You can ask for this stuff. I mean, maybe you'll get it. I told you, don't be surprised if there's a lot of decoupling in these markets. Maybe that'll be one of the decouplings. We have, the dollar weakening and oil weakening at the same time. Anything's possible. We are in the land of Oz. Now, some other market news, because these were some big declines, so I want to mention them. We had the Nikkei, which is the Japanese market, was down 2% today, which was 430 points. We had the Hang Seng, which is the Hong Kong index, that was down 2% as well, which for that market translated into 551 points. And then we have the Shanghai Composite, which is the Chinese stock market, which was down 4%, which was its largest drop in years. And the reason a lot of people believe that that was to the degree that it was today was because there was a major investment firm out of China that said to pretty much cool your heels, sell the market. Now, these markets, just like the U.S. markets, have been on a V-shaped recovery since the beginning of the year. So is this just a natural pullback? I mean, at 4%, that's pretty strong. That's pretty strong. Now, the Shanghai Composite, that's usually pretty volatile anyway. So, but nevertheless, a 4% swing in either direction is a pretty abnormal move. I wouldn't say that that is a quote-unquote healthy correction. You're usually going to have something steady, 0.5% here. Maybe you'll have a bigger 1% or 1.5% day, maybe even a 2% somewhere in the midst of a pullback that might retrace 5, 8, 10%. Again, I'm not going to be surprised if these markets retest their December lows. I mean, at the same time, that's what I'm predicting, and that's what I've been saying for quite a while. Obviously, there was the policy switch with the Federal Reserve that gave it a huge boost. Obviously, there was President Trump saying buy the dip, sending his Treasury Secretary out, plunge protection team coming to the rescue saying everything's fine, and then you have a 1,000-point rally. I mean, that type of stuff you just can't predict. I mean, those are the trump cards. Those are the wild factors, and that's what's running these markets right now. I mean, if you were truly looking at the data and just had an objective approach, I mean, you would say, yep, this global economy is slowing down, and if you have markets that are supposed to be forward-looking, I mean, things are going to get worse before they get better. And that's just a natural progression of things because we are so, oh my goodness, are we so deep in debt all over the world. It is bringing the future prosperity today. So you're robbing the future. You're robbing from the future so you can feel good today. You're not going to feel great when you have to pay the piper. You're not. You're not. You're just not. You're going to lose your job, unfortunately, or you're going to get part-time. You might lose your house. I mean, I don't take any pleasure in saying this stuff. I don't. But when people live beyond their means and don't understand money, and you have a very fraudulent and corrupt system with governments and central banks the world over who look out for each other and their top political donors and major corporations, and I don't like talking like this because it makes me sound like I'm on the left, and I am the furthest thing from it. But when it has to do with fraud, when it has to do with theft, and what I mean by that is theft is obviously your taxes. We are taxed to death. We are taxed enough. We are taxed every which way but loose, okay? It just does not end. And now you got the lunatics in 2020, Pocahontas, Crazy Bernie, and all of them. They just want to tax the rich and rich more and more and more. But let me tell you something. They don't have enough money to do it, to pay for all of these free programs. So guess whose pockets they're going to have to go into? Take a guess. Yours and mine. So get ready for it if you want socialism, because you are going to be broke as a joke. Mark it down. March 8th, 2019, Alex Kritis said it. Don't be surprised. So let's just hope that these lunatics, I don't even know, take a chill pill, that's not going to happen. I mean, President Trump going to pull it off again? I think he will. Maybe we will be saved from that insanity. But we got a lot of insanity taking place every day. It's one headline after the other. And a lot of them come from him. So who knows what's going to take place? Who knows? He's his own worst enemy. I want a weaker dollar, I want weaker oil. All right, we'll see what happens. So the interesting thing, again, getting back to the Chinese stocks, and the Shanghai Composite being down 4%. You had a major investment firm come out and say, like I said, cool your heels. What is sort of the message behind that? And it's this. It's highly unlikely that this firm came out with such a recommendation to sort of cool your heels, let's have a pullback, let's have a correction. They wouldn't have said that, most likely, without the blessing of the Communist Party. So that's basically, they are preaching the words of the government. They are the mouthpiece for the government behind the scenes. Okay? So basically the communists are the puppet masters. They're pulling the strings on all of this. So is that really a market you want to get involved with when the government is that heavily involved? I mean, as I say it, it's like, well, do you want to get involved with the U.S. stock market too? Because you got somebody who's tweeting and markets move in the direction they want it. Then you got the communists saying, we want it to go down, and then the market goes down 4%. I can't make this stuff up. The president wants to say this will never be a socialist nation. Well, then why are you tweeting about what to do with the stock market? Just stay out of it, because you didn't tell people to sell short at the top in October. You didn't say get out, look out below in December. You didn't say sell short or at least get into cash. If you're not going to do both, don't do anything. It gets me going. I don't like it because it's not what this country stands for. Don't tell me you don't want a socialist nation and then do these things. It doesn't make any sense. Now, getting on to some of the other information on Thursday where you had the ECB come out and talk about, well, we're doing a 180. Things aren't, not as good as we thought at the end of last year. Again, I don't know what the hell these economists are doing. I don't know what they're looking at. I really don't. If they even care. I think they just get together and they all concoct a story. We're all going to be on the same page. Has nothing to do with anything, just as long as we're all on the same page. And then, lo and behold, the data comes out and whoops, we're wrong. We have to change our minds. So let me just read a couple little things here from a CNBC article. So in regards to the ECB decision. So new monetary stimulus from the European Central Bank will do little to boost the region's sluggish economy and tackle its biggest risks, analysts told CNBC. Now, there's no question that there are other analysts out there who probably believe the contrary and that it will do something. I am in this camp. I don't think this stimulus is going to do much of anything, and the immediate response was a huge sell-off. In the European markets, the American markets, the euro went down. I mean, the dollar rallied. This was one of the biggest risks I told you guys when we had the conversation in regards to the 30 biggest market risks for 2019. Remember, I told you the ones that really, I don't necessarily know if I want to use the word scare, but sort of, I'll use that word, I guess, for the lack of a better word this time, that scares me the most is central bank policy of quantitative easing, lowering interest rates, and depending where you are, it might already be in negative interest rate territory. They run out of bullets. They run out of ammunition. There's no lead in those bullets. So if these guys who have been propping up the markets for the past 10 years, and the U.S. markets just hit their 10-year anniversary in a bull market, how are they going to last further if those policies that kept these markets propped up and going for 10 years are no longer effective? What's going to happen? Where's the bottom going to be? Because what catalyst are we going to have to support a global economy? Silence, I know. What are we going to do? What's it going to be? Because we already did tax cuts. We already printed trillions and trillions of dollars of funny money. We already have deficits, budget deficits running in the trillions of dollars. Nobody seems to care. That's all quote-unquote stimulus. It's all quote-unquote stimulus. It's running its course. You have over-injected the patient with morphine. You have over-injected the drug addict with heroin. And you're killing the patient. That's what's taking place right here. That is what is taking place right now. So we have the continuation of this article. The Eurozone economy saw its lowest pace of growth in 4 years during the final 3 months of 2018, data showed, in January. More recently, manufacturing data have shown a slowdown in activity. This comes amid concerns over global growth, tariffs between the U.S. and China, and weakness in emerging markets. The ECB slashed its growth forecast for 2019 to 1.1% from an earlier forecast of 1.7% in December. That's a big move in a few months' time. The bank also lowered its inflation forecast for 2019. Of course they did. Annual inflation is set to hit 1.2% this year when December forecasts had pointed to a headline inflation target of 1.6%. The ECB's inflation target is close, but below 2%. Of course, they are nowhere near their inflation target. That's what they tell you. Then why do we have people in France, the Yellow Vest rioters and protesters? It's not because things are too cheap. I mean, they are rioting because things are too expensive. Plain and simple. Plain and simple. And the French are usually early on. Look at their history. The French are usually pretty quick to pick up when something's wrong. I don't know if it's instinct, if it's in their blood. I don't know what to tell you. But that's their history. They are not afraid to revolt. They're not. They know something's wrong. They sense it, and it most definitely is. Now, a lot of it's their problem, too. They voted for a lot of this socialist utopia, and now they're coming to realize there weren't enough rich people in France to tax to death. And now they're going into the pockets of the middle class and the lower income people, and now they got to pay for it, and they don't like it. Wow, what a surprise. I feel for these people, but at the same time, I don't, because a lot of them, the same people who are protesting, are the same people who voted for that nonsense. So wake up, people. Wake up. We're always told by these socialists, look over to Europe. It's working greatly. Look at France. Plain and simple. Look at France. Ain't working. Sorry. No can do. Now, another interesting story. I'm not going to touch too much on this, but Deutsche Bank and Commerzbank out of Germany, and again, this was point number 31. I had to add this point to our 30 risks of 2019 because this list was comprised by Deutsche Bank, and there was no way that Deutsche Bank was going to say, yeah, Deutsche Bank might collapse or we might have to merge with another bank because we're in trouble and yada, yada, yada. I added that on that list. And now Deutsche Bank and Commerzbank, another major bank in Germany, who's also suffering, they are intensifying their talks and negotiations with actually coming to a merger agreement. This, to me, seems very akin back in, I don't remember the year off the top of my head, whether it was 2007, when J.P. Morgan and Bear Stearns merged. Well, really, it was more or less J.P. Morgan acquiring Bear Stearns with the assistance of the federal government before Lehman Brothers and a whole bunch of other things really started to cascade downhill. And then we had really the massacre of 08-09. So this, to me, seems very much akin to that taking place because the U.S. government was involved in helping that go through, J.P. Morgan acquiring Bear Stearns. Now you have the German government very much involved in being a cheerleader for the merger of Deutsche Bank and Commerzbank. These companies, especially Deutsche Bank by itself, is like Lehman Brothers on steroids. Well, Lehman Brothers really started this cascade. I mean, that was really the final straw on all of this back in 08-09. Deutsche Bank, if they collapse, I mean, their banks in Europe are different than that in the U.S., meaning there's different capital and reserve ratios, there's different requirements. U.S. banks, relative to European banks, in my opinion, are stronger. They have more solid capital reserves, they're better structured, they learned their lesson better during 08-09 and what to do. Not to say that the U.S. banks are strong. I just think they're stronger than the European banks. And because of that, and because European banks are smaller, they tend to take on more leverage. Okay? And that's the derivative markets. That's these hundreds of trillions of dollars just floating around out there. Who's the counterparty risk? Who owns what to who? You get where I'm going with this? This is another potential Lehman event. This is the German economy trying to cheerlead this negotiation together because they see the writing on the wall. The German government sees the writing on the wall, and there's a lot of people saying, well, look, Germany, you have so much money, you have to start stimulating your economy. Because remember, The ECB lowered their forecast. No surprise. Italy's in a technical recession. Germany just skipped out of one. And so people are saying, come on, Germany, you have all this money. You're the powerhouse of Europe. Start using your money to stimulate the economy. Well, I think the Germans know that some of their banks are in big trouble. And instead of spending it on infrastructure and things to help the people, they're going to save that for a rainy day in case they have to help out their big banks. Too big to fail, ladies and gentlemen. It is a global disease. Okay, and lastly, before I go, because obviously we have some big news here, in regards to the U.S. jobs report on Friday, this was a mixed/disappointing report. It was disappointing because the U.S. economy added 20,000 non-farm payrolls in February. The expectations called for 180,000, so quite the difference. February's headline reading for new payrolls was the weakest in 17 months. Now, we had some upward revisions to the December and January report, so that was good. That was good. More people were hired. The unemployment rate now sits at 3.8% from 4%, which is the right direction. But let me just set this out there as a reminder to everybody. Unemployment is always at its lowest shortly before a recession, because you're basically hitting those limits of full employment and where people who are looking for a job can find one. So employment tends to be a lagging indicator. And when you get to that point, you then start to see what is coming. And that is just what history tells us. We are at multi-decade lows, and we know that following these low rates of unemployment, that a recession tends to come in the near future. And this makes sense because we've also saw in this report, which is good news for employees, is on a year-on-year basis, wages increased 3.4%. Now, that's a good thing if you have more money in your pocket. Of course, we know what the inflation rate really is. It's a lot higher than the 1.8, 2.0% that we might be told. But nevertheless, it's in the right direction for these individuals and their families. But here's the caveat with that. If you have higher costs, what are companies now going to do? Because their margins, their profit margins might get squeezed. Well, what is a very expensive cost for employees if you're looking at their financial statements? Personnel, people, you and me. We are costly. We have wages. We have benefits. We have a whole host of things. So if things start to turn down because of a global economic slowdown or because of slowdowns just by things, transpiring here in the U.S., these companies might start to lay people off because they need the cash to pay off all the debts that they have. And they're trying to maintain margin. And they're trying to maintain market share. And they need the cash flow. So things always start to turn when employment is that low. Just be prepared. It doesn't mean it's going to happen, blink of an eye, flip of a switch. It takes time, but just be prepared. I don't know how much lower the unemployment rate will actually go. But what I do know is what history tells us, and when it gets this low, it's an indicator that a recession or some type of economic slowdown is waiting in the wings. All right, ladies and gentlemen, it's been a pleasure having you. I wish you all a very healthy and safe and fun weekend. We will catch you here next week. Please like, share, subscribe, get the word out. Leave your comments. I would love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.